next up here, let's talk about some stocks I'm looking to buy, including some new stocks here, okay? So what we're looking at is my possible buys watch list. This is my full possible buys watch list here. I have Amazon, Bath & Body Works, Salesforce, PayPal, Nike, The Planet, RH, Kava, Meta. Man, RH is all the way down to 141 now. American Express, Adobe, Google McDougal, Whirlpool, Elf, Chipotle, Cake, Celsius, Estee Lauder, Honest. Okay, so there's three stocks that I'm really looking at to potentially buy as my next stocks when I'm talking about brand new positions that I'm looking to start. If you're wondering like when would I start these positions, I would start these positions likely January or February. Okay, and so for the remainder of this year, which there's not much of this year left. Keep in mind, we got the holidays that's going to be disrupting trading days. I think there's only 30 trading days left in this year. Like this year is almost done at this point. So I'm already on to 2026. Like 2025 is a thing of the past for me now at this point in time. So in terms of some new stocks I'm looking to buy, I'm looking at RH. RH is a stock that I think if anything is going to go lower between now and year end. It's going to be lower than 141. Continuing to see tax loss harvesting that one. No one wants any piece of RH right now. And I wouldn't want a piece of it either right now. Like, talk to me in 2026. That's what I'm definitely looking at. I like that company for the long term. I hate what they did with their balance sheet. I need to see their next earnings. If their next earnings say, if the balance sheet's improved a bit, if their cash balance is built up a bit, that will give me some more comfort. And if they're profitable on the bottom line, that will give me some comfort as well. So I need to see that. The conference call will be what the conference call is going to be. But, if this market goes a little more south too, and let's say those earnings aren't everything it's cracked up to be, you'll see that stock at 99. Kava. This one I've always kind of pictured going under 40 or right around 40. In December, essentially. So that's what I'm looking at starting a position in. I really like Kava. I ran numbers recently. So on 1000X, we have a bunch of different things you can do on here that's very valuable. But one of the most valuable things is being able to run projections on companies. So I saved my Kava projections here. We made it so now you can save your projections when you're done and then load it up so you don't have to keep running the same projections on the same stocks again. But I've ran projections on Kava and it looks pretty darn good. Like if my base case works out here, which is 20% revenue growth on average, 26 through 29, and 35% net income growth, you could say a 60 to 80p would be fair for a company growing at that sort of growth rate, right? Like you're looking at a CAGR that's 30% plus here, right? So now you could take that down a bit. So here I did 15% revenue growth, 20% net income growth, 40 to 60 PE ratio, which is pretty fair for a company growing at those sorts of growth rates because we're talking about this is about a 3x of the market in general. And the market in general usually trades at a PE in the 15 to 20 range. So that's nothing crazy here. Even in a bear case like that, I still get between a 4 and 15% CAGR over the next 4 years, even under a bear case assumption. And then if the bull case assumption plays out, revenue growth of 25% per year, net income growth of 40%, gets their net income to 282 mil by 2029 and revenues of $3 billion, right? We're talking about, and this is net income margin 9%. This would be a Kava a little more mature at that particular time. We're talking about a CAGR of 40% plus, which is pretty darn compelling. Now, to compare that net margin there, 9%, compare that to like a Chipotle. I think this is very important. We'll pull up the compare feature here. I love this feature. You can compare three stocks side by side. So Chipotle, and then let's pull up Kava here. And so if you look at the net margins of Chipotle, 13%. So to assume Kava gets to like a 9% range, and their net margin's a little messed up right now. Keep that in mind in regards to Kava. But to assume Kava's at like a 9% net income margin or 10% even, come 2029, I don't think that's crazy to assume at all, to be quite honest, right? Chipotle's shown you can go to 13% when it comes to their net margins, if not a little over 13%. So just something to kind of keep in mind there in regards to that particular stock. Now, another stock I'm thinking about starting a position in 2026 is right here, Bath & Body Works. Bath & Body Works, like, boring business. We all know that, right? But this is one I'm really compelled with. I ran the numbers on this stock the other night and I was like, are you kidding me? Like, this is pretty darn attractive here. There we go. Bath & Body Works. Watch this. So I Oh, dang it, I didn't save my other cases here. Shoot. But I ran them at a 5% revenue growth per year, 7% net income growth, right? And we're talking about you could get a CAGR in the stock between 25 and 37%. Dang it, I meant to save my other cases as well. Well, anyways, I'll do that later. But Bath & Body Works is actually a pretty compelling stock. Now, as far as stocks I am already positioned into that I want to buy more, right? Meta's even looking like a deal now at this point in time. But Amazon continues to be one that's going to be a huge focus for me as far as buying, right? I like Honest a lot still. I like Estee Lauder a lot still. I even actually like Fubo. I need to add Fubo to this list as well. This is one I was taking a break on buying, but now that the deal's done, that took a lot of risk off the table in regards to Fubo. So Fubo is one I could continue to buy some shares here and there. It's a little more speculative. If this stock, if their margins start to increase quite dramatically in 2026, and if they turn to profit, like real profitability, now that the Hulu deal's done, if they do that in 2026, this is no longer going to be a spec stock anymore, which means I could actually buy this one pretty aggressively, right? EL continues to be a buy. I know it's gone up a lot from those lows it was back in April, but that continues to be a buy. Cheesecake continues to be a buy. Like Cheesecake looks phenomenal at $44 there. Celsius is a buy. Chipotle I've considered potentially starting a position there. Yeah, I mean, I might do something in regards to Chipotle. So I don't have Chipotle numbers here for good old CMG. But if we just ran, I mean, what would be a conservative number for Chipotle over the next few years? Like 5% revenue growth maybe. And let's say maybe like 7% net income growth for Chipotle. Let's say they're much slower growth. And you could say a 20 to 25 PE could be pretty fair for Chipotle under this sort of situation, right? Which is considerably under what they've been getting in the last many number of years. But keep in mind, growth might be slower. Nope. Yeah, Chipotle's a no for me. Let me just delete that one. Chipotle. Whirlpool's interesting. That could be a huge turnaround play if housing gets moving actually in 26, 27, which I assume 26 will be better in terms of amount of people moving than 25's been. And then I assume 27 will be better than 26. And I assume 28 will be better than 27. So Whirlpool could actually be a fun stock to be in from like a multi-year perspective. And Mr. Appaloosa Management. I think David Tepper's been buying a lot of Whirlpool. I think he owns, I want to say $300 or $400 million of the stock now at this point in time. ELF continues to be a buy here. American Express, really love American Express here. I believe I have my American Express projections saved here. Amex, there we go. Let me show you these babies on this one. So here's why American Express is so exciting. It's one of the safer business models you can really invest in my opinion, in the stock market. And under my base case here, I get a CAGR of 20% plus. You know, like, it's hard not to buy that stock with a CAGR, we're talking, 20%-ish range for a base case. For a stock that has that level of safety, right? There's one thing if it's a very dangerous stock and things could go really bad for them. But, I mean, look at even from my bear case on Amex, I still get a return that will probably be in line with the S&P 500, if not better. Ladies and gentlemen, that means that stock is a buy. Right? CRM continues to remain a buy. I don't know if I have updated CRM numbers that I've done here in regards to that one. Let me see. These might be old numbers. Let me take a peek here at Salesforce. Oh no, these are pretty normal numbers. I had them doing revenue growth of 12%. I think they're actually going to be a big beneficiary of AI. Because of some of their new products they have, and they just did an acquisition that should be closing. That's going to boost up growth very nice in 26 for this company. And I think their net income, it looks like, Benioff's going to lead that company very lean. So I think their net income will go much more rapidly than revenues are going up. And so this is another one I think could CAGR about 20% clip over the next 4 years. So I really like Salesforce here. A stock that's kind of hated, but I think it's a buy. And PayPal, huge buy. PayPal. Yeah, let me see my PayPal projections here for you guys. So load data for PayPal. And what do we find? We find my base case for PayPal. I'm getting between a 21 and 29% CAGR under my base case assumptions for PayPal. Like, shoot, pretty attractive, right? Pretty darn attractive in regards to PayPal. So that's another one that remains a buy. Additionally, want to let you guys know we are now only 8 days away from the big Black Friday sale for 1000xstocks.com. That is the entire software suite and the education portion of 1000x as well, okay? And when you join us in there, we'll send you your Steel membership card to your house, condo, apartment, wherever you live out there as well, okay? This is a private group card. This is a lifetime membership card. You won't get those cards because those are for my private group, but you will receive this Steel membership card. I got one right here, 1000x. This is a 2024 edition, so you guys will receive the 2025 Steel edition. We're going to have a deal on a 1-month membership and a 3-year membership, so that's going to be phenomenal. Pinned comment down there, enter in your name, enter in your email, and then I would enter in your phone number so we can text over the deal when it drops on Black Friday. Your inbox is going to be flooded with a bunch of BS on Black Friday. Get something that you actually can help you make more money, right? Like 1000x is going to help you make better investment decisions. You're going to be a much more informed investor if you get 1000x. You don't get 1000x, you don't get the deal. Like, good luck, okay? So get that deal. That will be pinned comment down there. Alrighty, ladies and gentlemen, are you ready to rock and roll? Let's get into this. Very important. If you look at the market since the 2022 low, right, which was in the fourth quarter, the Qs, which think of that as like NASDAQ 100, the big 100, market cap stocks in the NASDAQ, it's up 124%, a shocking move. Like if we went back to late 2022, no one saw this coming. No one. Even, people like Tom Lee were starting to get really like kind of bearish and just like very, very calm with their tonality. Let's just put it that way. Anybody that was bullish was scared to even mention they're bullish at that particular time because you've been in basically a year-long downtrend. And then the bears were in full-on onslaught. All the Wall Streeters were so negative on the market. I'm just telling you guys, no one saw this coming. The 124% gain since that low. In 3 years, no one. No one. Not one bull, not one bear. Incredible, right? Now, why has this happened? That's a very important thing. It's really been led by 4 core things. The first is big tech's revenue growth. Big tech was in a bad spot at the end of 2022 going into 2023 when it came to their revenue growth, and they completely reversed that, and big tech has gotten back to very strong revenue growth over the last 3 years. That's one of the big reasons this gain has happened. Additionally, if you look at the big tech stocks, the ones that matter the most to the market, they've had earnings per share increase quite dramatically, and margins, we're talking gross margins, net margins, have been increasing quite dramatically for those companies as well. The only one I can think of that's a big dog company that hasn't had that is Tesla. But outside of them, like basically every single other stock out there has basically had major earnings per share and margin expansion as well over the last 3 years. Additionally, big share buybacks. Almost all these big tech companies, pretty much all the big tech companies have been doing massive share buybacks, and that helps your earnings per share even more, right? And then we can say chip spending has definitely helped this whole wave as well with NVIDIA stock. NVIDIA has become the biggest market capitalization company in the entire world. It definitely used to not be like that, and that has definitely helped push the Qs up as well, right? So those 4 things are why the stock market has increased as much. The Federal Reserve lowering interest rates a little bit hasn't done a dang thing. It hasn't mattered at all, just to be quite frank. And even when the Fed was starting to still raising interest rates, the market was already going up. And that's because big tech revenue started to trend the other way, right? Earnings per share and margins started to increase. It did, a lot of firing of employees, all that sort of stuff. So the market was already bouncing heavy way before the Fed could even think about stopping to raise rates or even think about cutting rates. These are the 4 main reasons why the stock market has increased so dramatically, and specifically the top of the market over the past 3 years, okay? Now, what if I told you all the 3 of these 4 categories are under attack over the next 24 months? What 3 categories are they? Earnings per share and margin growth, big share buybacks, and chip spending. They're all potentially under attack the next 24 months. And let me explain it to you like this. This is extremely important. Everybody understands this, okay? What's occurring right now is unbelievable spending when it comes to all these companies on CapEx and, with all the NVIDIA chips and then building out these massive data centers and everything like that. All these companies are spending a fortune. When I say all these companies, I'm talking about the big dog companies, the Metas, Googles, Amazon, Oracle, like go down the whole list of them, OpenAI, et cetera, right? So this ends up catching up to you in a pretty substantial way, okay? And here's why. So let's say Meta spends $72 billion on CapEx in 2025, okay? Now let's say they're going to depreciate all this CapEx over the next 6 years, because a lot of these companies have now moved to 5 or 6 year cycles. Some are at 5.5 year cycles, are saying. So all of a sudden, Meta has to start taking a $12 billion depreciation hit per year. They have to take that in 26, 27, 28, 29, 2030, and 2031. Okay, that's already a big number. That's going to kill a lot of your earnings per share growth because it's hard to increase your net income $12 billion a year. But here's the issue. Meta's already been spending, and they're going to keep spending even more aggressively, right? Zuckerberg's talking about much more aggressive spend next year. So maybe they bump that up to $90 billion of CapEx in 2026. They need to depreciate that over 6 years. That's another $15 billion depreciation hit per year. So now Meta is getting hit $27 billion of depreciation. Ooh, do you see where this starts to become a problem with your earnings per share, right? And everybody that, if you understand income statements well, you know what I'm talking about right now. If you don't understand income statements, I apologize, but, understand income statements, okay? Join my private group, take a college course on accounting, do something, okay? Get the sale for Black Friday for 1000X. We have a whole, basically module inside 1000X that explains income statements. Everybody that understands income statements, you know what I'm talking about right now, okay? Now, Meta, let's say they bump that up to $102 billion, a very small increase on a percentage basis. That's only a little over 10%, increase of CapEx into 2027, right? They still need to then depreciate that over 6 years. That's another $17 billion hit. Now we're talking about Meta's now taking $43 billion depreciation hit per year. $43 billion, ladies and gentlemen. It's hard to increase your net income $43 billion. So what ends up happening essentially is your depreciation starts to become so massive. It basically is wiping out all your net income increase, and it looks like you can't grow your earnings per share as a company. That's no bueno. That's no bueno. And then you could say, well, maybe investors start to judge these companies just on EBITDA, right? Which is earnings before interest, taxes, depreciation, and amortization. That's a possibility, and EBITDA is an important thing to look at, but you got to understand, people really like the net income in the EPS because some people look at EBITDA as BS earnings, essentially. Why? Well, if you're just looking at your earnings, but you're not taking into account all the interest you might have to pay if you took out a bunch of debt, or the depreciation, and all those sorts of things, like your taxes, people are like, well, that's not giving you the full picture. That's just a very small window. How much are you actually bringing home at the end of the day? Where's the bacon at? And how much bacon you actually bringing? Because this is we still need to divide up the pack of bacon at this point in time when we're talking about EBITDA, right? And do you know who would always call it BS earnings? The late, great, rest in peace, Charlie Munger, Buffett's right-hand man. He said, I think every time you see the word EBITDA, you should substitute those words with BS earnings. Here's the deal, okay? EBITDA is important to look at, but the moral of the story is, on a mathematical basis, right? Companies, all these big tech companies that are spending a fortune, their earnings per share and their net income, it's going to be really hard to increase those in any substantial way over the next few years because these companies' spending is so out of control. It is getting so insane where some of these companies are now spending more in a quarterly basis than they're bringing in profits, ladies and gentlemen. That's how extreme it's getting. And these companies are talking about taking it up to another level in 2026. This is all going to catch up at the end of the day. This is all going to end up catching up because you can only get away with that for so long before the market says, nope, no more of this. This is out of control, okay? So all this depreciation is going to start to kill net margins of these companies over the next few years, and it's going to kill earnings per share growth. Right? That's a problem. And so we're about to run into a situation that we haven't had for years, which is going to be around earnings per share and margin growth. That's going to be tough. Some of these companies, their earnings per share and their margins could start heading the wrong way in 2026 because of the massive amounts of depreciation. Okay. What about share buybacks? The big share buybacks. Here's the deal. If all these companies are spending, $50 billion, $100 billion on CapEx. Guess what? They don't have all the extra money to go spend on share buybacks. So if they can't buy share buybacks, remember, almost all these big tech companies are always diluting shareholder value. You know why? Because they're usually issuing a ton of shares to their employee bases. In the tech field, it's very commonplace to essentially get paid out in a lot of your equity in shares, right? So these companies are going to have to cut back massively on their share buybacks. The only one that I think could get away with doing massive share buybacks over the next few years is Nvidia, because they're the ones that actually bring in home all the money, right? And they don't have to deal with the crazy amounts of depreciation that all these other companies do. So the share buyback situation might actually get much tougher because these companies are like, we need to spend, like Meta's worried about spending $72 billion this year. Next year, they might spend $90 billion on CapEx. Where's Meta going to get the money that's going to eat all their profitability? Like all their profitability is just going straight to CapEx. So they have nothing left to spend on share buybacks, which means if anything, the shares outstanding could potentially go up. So there you just lose another leg of what's carried us higher over the last 3 years, which is share buybacks, okay? And what about the last one? Chip spending. Well, most of these companies are not going to be able to increase their CapEx in any substantial way in 27, 28, or 29 because the depreciation is going to catch up to them in such a major way, and the massive CapEx numbers is going to catch up to them in such a substantial way, right? Which means chip spending, that's in terms of the growth. That doesn't mean these companies are going to stop spending. That doesn't mean if Meta goes to $90 billion of CapEx, that doesn't mean suddenly Meta's like, we're not spending on CapEx anymore, cut it to zero. No. They could just do $90 billion again the next year. But the problem with that is then you're getting no increase in the amount of spend with somebody like Nvidia, which means Nvidia's revenues then do what? They flatline. If Nvidia revenues start flatlining, no one wants to own Nvidia stock when it starts to flatline revenue, because usually what happens with Nvidia, once they flatline revenues start going negative. No one wants to own Nvidia when the revenues are going negative. There's just no way around that, right? So there we run into 3 issues all simultaneously. That's a problem. Right?